specific on that, and then they can send you out literatures on that. They can email you literatures because now everything is such an email process. They can email you information on that, and then you can get that, or they can tell you where to go to download. There it is, to download information, so you can get that information at your disposal, making it very, very accessible for you to have that information. Man, isn't that wonderful? You're doing your research, you're getting out there, and you're getting good information, and you can get it directly through HUD, not through a lender, not through a realtor, but you're going out there getting it from the people who designed the program and who is going to be their what? Investor of the program. Remember, the lender's going to be your servicer. The lender's going to be the servicer. HUD FHA is going to be your investor. So now you get it directly from those that created the program. Information come from that source is more valuable than you get it through second and third party. Okay. That's why I ask you to go out to do further research, because I'm only human. I'm supposed to make mistakes, and I may have missed a few information. And so, but giving you enough that you can find it and strengthen yourself in knowledge while you're doing your research that we are encouraging you to do. Now, getting back to the qualifying types. So the single family homes can qualify. The 2 to 3 to 4 units can even qualify under the Title II mortgage program. In addition to the standard homes, other residential types such as condominiums can qualify. Okay. Manufactured homes and trailers can qualify. They may also they can qualify for the Title II loan. Sorry, the home must have a permanent foundation and meet minimum size requirement based on its residential type and structure, sound structure, and fit for a family residence. So you got to meet the qualification status of that when you're under the other type of homes like the as I mentioned just a while ago. Okay, got to move on because a lot of information to cover. Okay, the loan process. FHA does not listen. It's very important. FHA does not issue Title II mortgage directly. Okay, they're not a lender. Okay, they are your investor. And because they insure it, they guarantee. You need to check with lenders and find one that offers mortgage loans that are FHA backed through the Title II program. Okay. Application process is similar to that of a standard mortgage loan, though the lender will check to be sure that the home you're buying meets the Title II requirement. The interest rate are often lower than you would receive without using the Title II. So it's lower than the average conventional loan. It's lower than Fannie Mae and Freddie Mac loans. You follow me on this? Lenders like this program that I'm about to tell you in a moment. All right. And your repayment term can go as high as 40 years. If you don't want 30 years, you can get a 40-year mortgage under the Title II. Now, you can still, what it says here, up to 40 years, you still must pay closing costs on your loan. So you cannot incur that into this loan. You have to cover your closing costs. Okay. Now, what makes this loan so good that these lenders not only sign up with HUD to have, and that they sign up with HUD and they have this program? Well, this is what makes it attractive for lenders. The reason why that they lower their criteria, their standard criteria, they lower it to the FHA level to help people to qualify, so more people can qualify, because their criteria is just a little bit too high. So HUD got to give them some incentive, and then this is some of the incentive that HUD gives them through the mortgage insurance. The Title II mortgage loans are protected by mortgage insurance issued by the FHA, the Federal Housing Authority. This insurance reduces the risks that the lenders assume when issuing a loan, since the insurance covers its losses if you default. Because of this insurance, the Title II loan requires a little as 3.5% down, just like the regular FHA loan do, okay, of the cost of the home you're buying as a down payment, okay? Since the insurance is issued by the federal housing authorities through FHA program, the cost of the insurance is typically added to the mortgage, so you won't have to pay a separate insurance premium. That is not, as you know, that's called PMI. That is not your homeowner's insurance. Buy and repair homes. The Title II can even help you if you want to do that. Listen up. One advantage of the Title II mortgage program is that the cost of repairing a fixer-upper can be absorbed into the mortgage. You didn't hear me. Say that again. One of the advantages of the Title II mortgage is that the cost of repairs, known as a fixer-upper, can be absorbed into the mortgage. When taking out a loan for a home that needs repair that you're interested in buying, you can include the cost of material, labor, all of that in an amount can be included in the borrower loan and still have a full mortgage amount covered by FHA mortgage insurance. This is designed to encourage urban renewal and purchases of property with the intent of repairing, remodeling them as a primary residence, which will improve on urban areas and neighborhoods and communities. It is designed for that. You can also even refinance into this program if you have some repairs on your current home that you're a homeowner on. You can also refinance into this program to do so. Remember now, there's several versions of this program. You have to find the right version that can offer you that, and this is one of them. Okay. You can also find a fixer upper on here to do that, and that could be incurred. What you have to do is that you go out there and you get 3 estimates from 3 builders. Okay. You must make a decision on which one of these builders that you want to do the repairs. Okay. Your loan professional or your mortgage broker that I encourage you to get will provide you with the necessary documentation forms that the builders need to have so they can provide their information on there. Copy of their license and bond. Okay. And then with that, you're able to use that particular builder, and that particular builder can start improving on your home. There's no side deals that can be made. Any side deals for that builder to go on your title as a second lien for something extra must be approved by HUD. Okay, has to be approved. Normally, the Federal Housing Authority only wants to be the primary investor on that title. Okay, there are some exceptional points to that particular factor, especially when it incurs maybe 5% of a closing cost that you don't have that can be incurred in that. But again, it has to be approved by the underwriter. It has to be approved by your investor. So any side deals that's going to be done. We want our money up front. We don't want to wait till no closings. Therefore, we're going to put a lien on the property. So when you close, they can't do that. They can't do that. And HUD won't let them do that. Okay. And that's going to be part of the contract stipulations that's going to be given to them to sign so they can return that to you. That's going to be in that contract stipulation there. Because that's an agreement. Anytime you hire them to do repairs, you're signing a contract. You don't have to say contract, but it's a contract. And in the contract clauses, there are stipulations there. And so that's why there are special contracts to be issued to these contractors to help protect your interests. Your interest, homeowner, so they can't pop up no liens on it because we decided that we want to be paid within 2 weeks after we do the repairs. Okay, everything is in there to help to protect you because that's going to be incurred into your loan, and usually they are paid in increments. As at each stage of the repairs are done, it is divided up into increments. And so they're paid that way. Don't you ever take a lump sum, even if you have total control. Don't you ever take a lump sum and give it to the lenders and then hope and pray that they do everything and meet up to every standard. HUD do have inspectors that will come out to look on these repairs, making sure that it meets the standard. They will have a FHA appraisal that will come out and assess all of the damages. So you can get a nice little sheet on what need to be repaired. And then FHA appraisal, who's also an inspector, will come back to inspect each stages of completion and will sign off on that. And each time that he signs off, guess what? Click, click, click. Some more money can be released. Okay. So that give you your protection there. All right. Just want you to know that. So we talked about the qualifying type, the loan process, the mortgage insurance, buying and the repair. Now, I want to talk to you about something that I talked to you about 3 weeks ago. That's another program that can be plugged into this particular program, and that is the Graduate Payment Loan Program. It's a missing puzzle piece that can be plugged into this program. Even after you've gone through all of this and made your qualification status, you see the payments, you decide to go for a 30-year, you didn't want a 40-year, or you went for a 40-year and you just didn't, and you feel that you want the payments to be a little bit lower, but the credit score can help you get it to that point. Then you can utilize this program as a second program that can be plugged into your Title II program. This program is also used to be plugged into the Title I program just as well. It is called the Graduate Payment Loan Program, offered by HUD and offered by FHA. This is a full loan payment. Will make your money a bit tight. Let's say that this loan makes your money a little bit tight. You can reasonably expect your income to increase. You know that your income is going to increase. Okay, it's going to increase over a 5-year period of time. You know that it's going to increase. So you may qualify for a graduate loan payment on your Title II mortgage. The graduate payment loan starts off with a minimum monthly payment, then experience an increase in payment amount each year. As you continue to make more money, your mortgage payment will adopt until you meet the full payment required by the loan. Now, that's going to put you into a negative amortization. And so therefore, it's going to take you longer to acquire equity into the property, because you basically are not paying the full amount of the interest. You're paying just a small portion and a very small portion to the principal. Okay. When you get into the negative amortization, if you want to learn more about the graduate loan payment program, go to blogtalkradio.com/mortgage talk 1. You can scroll down and you can get the FHA graduate loan payment program, or you can go to speaker.com/WHPNN/8501-589 and look for the graduate payment mortgage program offered by FHA. I did a whole show on it, and so it's going to give you some good information on how it moves up, gradually up, explaining what a negative amortization is, and explaining how this program can work for you and how you can maintain control of this program, because the key factor is that your income is going to go up simply because you're in class right now. Okay, you're going to have your master's, or you're in class right now studying on the position that a company is offering, and that's going to increase your income. But yet you got to take this class up for the next year or 2 or 3, so you know that's going to happen. So income is going to increase. That where the graduate payment loan program can work for you, so you can keep your payments really low. It's going to be low in starting off, but it's going to increase each year up to 10 years before it caps off for you. Okay. So you're going to learn about the program. Just go to speaker.com/WHPNN/8501-589. Scroll down and get that. Listen to that. It's going to give you some good information. Then go out and do a little bit further research so you have a crystal clear understanding of what the program is all about.